Almost everyone. I suspect there are still some people hanging around watching Yanis Varoufakis. Our next session has become a bit of a feature of our conferences, and I'd like to welcome Nicola Horlick, who is founder and chief executive officer of Money&Co, Nick Hungerford, who is director and chief executive of Nutmeg, and Euan Munro, who is chief executive officer at Aviva Investors, to participate in our latest balloon debate. They are going to make their cases about the role of disruption for savers and the economy. And what we found when we started to discuss disruption was that actually all of our speakers are in favour in some form of disruption. And so each of them is going to take about 8 minutes to pitch their case for where we most need disruption and what direction that should take. Then you'll be asked to vote for your favourite speaker via our conference app, so please get it ready. And the lowest scorer, when you've had that vote, will be eliminated. The floor won't open and swallow them, but they will be eliminated. And then we'll give the remaining 2 speakers 3 minutes to pitch their case again before we decide who the winner is. So I think we're going to start with you, Nicola.
Thank you, Lesley. So our industry has actually seen huge disruption over the last few years. We've had things like RDR. That means that there are large numbers of individuals who now don't have any advice because their IFA may have retired, or the IFA doesn't want to deal with a smaller investor, so they have no means of getting advice. We've then had the government making huge changes to pensions, which means that people can, if they want now, take money out. And in addition to that, we had, in the first place, DB schemes closing their doors to new members and DC schemes arriving on the scene in a big way. So all of this means that the individual is having to make more choices and decisions about their finances. And that's in an environment where they don't have a great deal of knowledge necessarily in the first place about finance, and in also an environment where things have been very difficult as a result of the financial crisis and markets have been very volatile. So there's been massive disruption, which has resulted in individuals having to take more control of their own financial assets and work out what to do with them. And that's only going to get worse from their point of view going forward. So I think the thing that we need to do as an industry is to think how we help those people and help them to make the right choices. There are some things about that are quite good in many ways, in that an IFA is very driven by short-term performance, and often they would put money into one of our funds, leave it there for a year, and then say, we don't like this year's performance, so we're going to now put it in somebody else's fund. Whereas all the statistics and all the evidence shows that individuals are what we call stickier. And so often they might make a decision about investing in a fund in an ISA and leave it there for many, many years. And in fact, I've seen research from one fund management firm that shows that the average length of time that somebody holds a fund in an ISA, the same fund, is 12 years. So in some ways, you might say it's quite good news for the fund management industry that there's been that disruption and that more control is in the hands of the individual. When it comes to pensions, though, it was clearly a lot easier for us as an industry to go along and make a presentation to a board of trustees and be given £500 million than to actually have to persuade lots of small individual decision makers to actually give their money to us to manage. And so that does cause a major problem for the industry and means that we have to prove to those individuals that we're the ones that are worth having the money, and we have to organise ourselves more effectively. And this is where disruption in terms of distribution can be helpful. The internet is a very good means of first giving people information and helping them to learn more about how it works in the first place. And secondly, as a means of distribution, it's cheaper than having large numbers of people spread all over the country trying to tell people with relatively small amounts of money that they should give us their money rather than somebody else. So I think we have to harness technology and use that to help gather up all those investors and create an environment where they're better educated and they have a better understanding of what's on offer. And it is a very complex area, as we all know. And the general feeling has always been that when you're younger, you should start off with more in equities, and over time you should put more into fixed income, and that you should have lifestyle management of your pension entitlement. So that's the very basic concept that we somehow need to get across to these individuals that are now making the decisions. But within the actual asset management industry itself, I think there is plenty of opportunity for more disruption, because when you look at how things are done, it hasn't actually changed markedly since I've been in the industry, which is 33 years now. So we still have large teams of fund managers spread across the world looking at equity markets. And yes, we have seen disruption in terms of more money going into index funds, ETFs, and so on and so forth. And the question is, what is the real value of having active management? Is it really adding any value? Or is it just a massive cost base that doesn't really need to be there? All the academic research suggests that the biggest decision is about asset allocation, that the way you can add real value is deciding whether you own Japanese bonds against UK equities rather than whether you own Glaxo as against AstraZeneca. And so it may be that asset managers should be looking at their cost bases and deciding we don't really need to have these huge research teams and all these fund managers spread across the world. Actually, maybe what we should do is just use ETFs or index funds and focus all of our attention on strategy and asset allocation. That has the result of reducing cost, and fees are heavily under pressure because of all the changes that have occurred. So maybe that would be a better way of doing it. There are also many asset classes that most general asset managers don't really have much exposure to. And I think we need to get away from the idea that it's all about equities and bonds. And many fund management firms do have a spattering of private equity or a spattering of forestry or something, but it's not that significant. And maybe there should be more of that type of investment going into portfolios. Now, the counter to that is always, well, what about liquidity? Because we've got people coming and going out of our funds the whole time, and if somebody wants to realise their investment, they don't necessarily want to be in something that's very illiquid, and that is an issue. But on the other hand, I think if we're trying to create portfolios that are actually tailored to the needs of the investor, where they need more income towards the end of their life, because of what's happened in markets and the printing of money and the use of the gilt market in the UK and treasuries in the US to actually implement quantitative easing, it means that all of that looks extremely expensive and rather dangerous for the general investor. So you have to somehow find other means of creating yield. One area that you can create yield is by doing direct lending, which is something that my business, Money&Co, does. So that might be an example of where fund managers should be moving away from the traditional areas and looking to supplant the banks in areas which they are finding it difficult to operate in now because of increased regulation and constraints on them. So that might be a way in which you can disrupt actually what the banks are doing and to the benefit of our underlying investors. So I think we have to look at this in two ways. There is the disruption that's already occurred, and we need to be focusing a bit more, I think, on how we deal with that. Some of these things are only just happening. The pensions reforms are only now really beginning to hit. And so it's how do we help individuals make sensible investment decisions? And then the other major question is, how do we provide them with the right product, and how do we develop new investment markets which move away from the traditional equity and bond areas to create yield and something better for those who are retiring and need income? Thank you very much.
Thank you, Nicola. Bang on time. And now I'm going to ask Nick to join us and present his case for disruption.
Well, good morning, ladies and gentlemen. We have been brought here together to compete and to talk about where disruption is needed the most and what direction that specific disruption should take. In my time, I shall be arguing that personal asset liquidity is not only the innovation that is needed the most, but it is inevitable. And therefore, we need and must, right now, start to determine the direction of travel that this should take and the guidance around it. Plato is quoted as saying that human behavior flows from three main sources: desire, emotion, and knowledge. These three pillars of behavior will be key to understanding why personal asset liquidity is so important. We live in a world where the characteristics that define different generations are radically different. A baby born now can use an iPad before they can speak. A 25-year-old will never retire, and they certainly won't benefit from a state pension. Millennials want career breaks every 8 years, whereas Generation X are the hardest working ever. Transparency and liquidity of personal assets is important because we need to show all of these different types of people what asset base they have, what wealth they can expect, and how they can facilitate their financial survival. Over the last 20 years, the ability to value and transact in personal assets has increased dramatically. This is because, as money managers and as individual customers, we are on an ever-increasing quest to find ways to diversify, to match our liabilities, to build multi-asset solutions that protect and grow wealth in times that are increasingly volatile. I offer you 3 case studies of where this has happened. First, in housing. In 2008, Zoopla was launched. And through their use of the automated valuation model, which was previously only used by institutions, and that is a model which matches real data with computer financial models, they have provided consumers with information where there was already plenty of emotion and desire. Real-time house valuation. It is not surprising that this transparency spurs activity. In England alone, in 2011, there were 755,000 housing transactions. In 2015, there were over 1 million. That's a growth of 40%, and the housing supply has nowhere near grown like that. Second, in pension reform. As I don't need to tell you, the Pensions Bill of 2014 ushered in an era of easy access and lump sum withdrawals. Unsurprisingly, customers started taking more interest in their valuations. Third, physical goods. PayPal's volume in 2009, 20 million transactions. Last year, 15 trillion. Annual active buyers on Alibaba, Q4 2012, 160 million. Q4 last year, 407 million. Almost 5 times the population of the UK. So that's where we've been. Now let's look at where we're going. I'm going to take one example from the financial system and one example from society. Most investors consider alternative assets to be illiquid, things like hedge funds, private equity, and so on. But these are traditionally not half as illiquid as items such as cars, pictures, or the Ming Dynasty vase that you have at home. However, not anymore. Companies such as Trove are offering instant valuations on your property, instant insurance, and instant marketplaces. And societally, perhaps the least liquid asset of all, ourselves. In 1865, slavery was banned in America. However, selling yourself is back again. There are many companies, and I'll highlight 13th Avenue, who now offer students a loan in exchange for a percentage of their future earnings. But this is all happening too slow. We need transparency over all of our assets. We need liquidity over all of our assets. Facilitating liquidity over all personal assets can solve our problems relating to education costs, health costs. It gives us the chance to fairly and importantly manage a financial system, for example, to understand the amount of social security payments required in future years to come. So if it's going to happen, and it's so important, what direction will it take? I'll focus on 2 aspects: the delivery and the control of personal asset liquidity. In the past, valuation and liquidity, the channel for that has been the pawn shop. The enduring characteristic of this, of course, was exploitative nature. The seller urgency forced a price gouging of the seller by the buyer. The pawn shop provided liquidity transformation like banks, but it was physical assets instead of credit assets. Now, online has gone a long way to helping us to disintermediate this kind of sale through shops like eBay and Alibaba. And this is improving with Amazon's drone deliveries, currently being tested in Seattle, soon to come to London. But we need more. We need more in terms of safety, more in terms of immediacy, to make that marketplace great and usable. Innovation must drive both cost and service. Secondly, control. 33% of people admitted to the Wall Street Journey last year that they lack financial discipline. Too many people spend money they have not earned to buy things they do not need to impress people they do not like. How will we ensure that people only do spending with the money they have? And at least, how do we ensure that they acknowledge the impact that their decisions financially will have on their future lives? In conclusion, ladies and gentlemen, the most important innovation in financial services over the next decade will be the provision of instant liquidity in personal assets. This innovation will define how we as individuals behave. It will define how society behaves and regulates itself. I've proven through facts and figures and examples that this is a trend that is rapidly becoming a reality. Now we must ensure that this innovation is not simply unleashed, as is currently happening, without a framework for people to understand the implications of their decision-making. So if you vote me back on stage for another 2 minutes, I will share more thoughts with you on how we can control the inevitable. Thank you.
Thank you very much, Nick. And can I ask Euan to come to the stage, and can I remind you to have your conference apps ready so that you can vote for your favourite? Euan.
Thank you very much. I was trying to look innovative. I'd changed my normal business style of dress today and maybe look a bit more like a tech entrepreneur, but I've ruined it by putting a tie on. I'm going to talk briefly about good disruption and innovation and bad disruption and innovation. I think our industry could do a good job in clarifying the objectives of funds. I actually think that describing the risk of a fund without a clear intention of the fund to deliver some sort of outcome is a cop-out, and that's rife with our industry. We describe things as low, medium, and high risk, allowing people to make the shorthand assumption that high risk is going to deliver higher return, which it doesn't always. I think we need clarity about the drivers of return in investment solutions. Is it coming from straightforward beta? If it is, I think we should all be worried about those kind of solutions, because beta has been buoyed up by about 25, 30 years of declining interest rates. So if you drop the discount rate on assets that are priced off a discounted claim on future cash flows, asset prices go up. And they're very high at the minute because interest rates are very low. That's been a fantastic tailwind for beta, but maybe won't look so healthy over the next 10, 15 years. So is it beta? Is it skill and judgment, fashionably called alpha? Or is it illiquidity in some of these alternative asset classes that we've been hearing about? Another thing that would be good innovation would be fund managers being able to give greater clarity, a real 360 perspective on the risks that they're running. Bad innovation, we've seen plenty of examples of that in recent history. I can remember great innovation in the credit markets around the time that credit stopped being rewarding, and we saw CLOs and CDOs, we saw structured credit, we saw tranches. And can anyone remember 130-30 funds the equity managers wanted to bring? They've not really taken off. And when beta isn't rewarding, is that the environment people start talking about smart beta? Because they realize it's maybe towards the end of the game for these things. The other thing that can happen with bad innovation is people data mine for things that have worked and propose without any evidence it's going to work out of sample. So I think we need to be very clear about what's good disruption and innovation and what's bad, and I've outlined some thoughts on that. If I'd been asked to debate this in 2000 to 2003, when we were in the depths of an equity market, bear market, I would have said that the pressing societal need at that point was for people to have funds that delivered reasonably reliable returns with low volatility. Because of the support from quantitative easing, most people are sitting with quite sizable asset pools if they've been saving at all. The issue at the moment is income. And so what is needed right now is the ultimate drawdown fund for people to move into retirement and be confident that they're going to have some income to be able to live in dignity in retirement. Very difficult to see how that happens when we've got substantially negative interest rates across swathes of Europe out as far as 8-9 years on the bond curve. How do you actually generate a decent income? So the ultimate drawdown fund has to be a solution. Unfortunately, there's forces that are acting against that. Just simple, that axiomatic link between risk and return. The broad assumption that low fees are good and high fees are always bad. Sometimes it costs more to build a great solution. If I was to go into a cycle shop and ask for a crash helmet, because ultimately a drawdown fund is to give you protection. The first few years in retirement, you're massively path dependent. If you've got a fund and the market goes down early on and you start drawing out of it, that is really seriously bad for your future wealth. So the path that markets take is critical. You need protection. You need that downside protection in a good drawdown fund. So if I wanted protection, and I went to the cycle shop and I said, I want a crash helmet, I'm a cyclist, if I fall off, I want to know that I'm in some way protected. And they said to me, well, we can't give you that, but we can give you a hat that's the broad average of everybody that's wearing a hat at the moment. So it will get more peaky in the summer and you won't see, you'll have some protection from the sun. It will get more woolly in the winter and you'll be a bit warmer. It will get frilly on Ladies' Day at Ascot. And if you fall off your bike, you'll be no worse than the average hat wearer. I think I would shop somewhere else. And that is, quite frankly, the option that is offered to a lot of people who are encouraged into low-fee, passive solutions that are not going to solve their problem as they move into retirement and they want the ultimate drawdown fund. So let's have some innovation for the ultimate drawdown fund for people moving into that crucial stage of life.
Thank you very much, Euan. I'm going to make you stand up again now. So can I remind you to go to your conference apps and vote now? I think the voting is open. And can I ask the brave debaters to come back to their lecterns whilst we wait for that vote to appear? Now I'm supposed to tell a joke or do a dance or something, I think, whilst the votes come up. Here we go. And it looks like Nicola, I'm afraid you are leaving us. Thank you very much, Nicola, for participating. I'm now going to ask Euan and Nick to stay because it's only 3 minutes. And Nick, if you're ready.
Do we challenge each other or do we just want to talk for 2 minutes?
You can just talk for 3 minutes or 2 minutes. Yes, please. Well, you can challenge one another if you want to.
I was kind of quite excited by the active-passive debate there, but
Go for it.
We'll do that at lunchtime.
Go for it.
Well, okay. I'll follow the instructions, otherwise I'll get told off as usual. Okay, 3 minutes? Right. So personal asset liquidity, the ability to sell anything you have, wherever you are, whenever you like, to someone who may or may not necessarily be in your physical location. In China, it was pioneered, their equivalent of eBay, by dropping off anything you wanted to sell at the phone box. And anyone that wanted to buy it could pick it up. That's quite an archaic system in a world where you can have drones to pick anything up from your office and put everything, just fix it onto the drone and send it off to people. This is an inevitability, but a lot of this could be used to finance things that we really don't want in marketplaces. If you think about alcohol for underage people, weapons, firearms, money laundering, we need to make sure that we have a good system and how we do this is done properly. So 4 key points. First of all transactions should be reported through a regulated exchange. Example there, taxis. I started off using taxi apps 3 years ago because I didn't have cash in my pocket. Now I use it because it's incredibly convenient, and I tell myself that it's possibly too late and too dangerous to take the tube. What I need to know is that transaction goes through an exchange so that I can compare the different taxi apps, make sure I'm getting the right prices, make sure I'm getting the best prices, make sure I'm not getting ripped off like I would if I just went to one supplier in the pawn shop. 2, transactions over £20,000 need to be registered. This is the same as any money laundering directive that we would have in our financial services industry at the moment. Make sure that large value transactions are registered, make sure that the people who are doing that buying and selling take the right precautions, and make sure we can track the money. Number 3, a traffic light system. If someone is selling too much and not providing enough for their future, then they should be given red, yellow, green warnings as to what they will need for their future survival. And that's wrapped up in the fact that we need a personal dashboard. I'm not just talking about the pension dashboard, which many people know is underway and will be live in the next couple of years. I'm talking about a full personal asset dashboard so that we can see through linkages with all the different exchanges, whether it's the taxis, whether it's the brokerages, whether it's the retirement providers, whether it's the banks, we can see how much money everybody has. And I think that will be a reality by 2020. So, in summary, of course we need proportionality. We need proportionality of regulation pre and post sale. It shouldn't be the exchange's job to do all the KYC. It should be the person who's buying and the person who's selling to make sure that all gets done correctly. But I want to make sure that when personal asset liquidity becomes a truism, we have it properly regulated, properly organised, and properly facilitated so it really does work to the benefit of individuals and society.
Thank you, Nick.
Thank you.
Okay, if I can respond to that. I've got the luxury of speaking second, so I can nick some elements of the previous idea and incorporate it into mine. So, for example, if we do live in a society where people haven't saved enough, so my concept of the ultimate drawdown fund only works if you actually have a fund to start with, and many in our society scarcely do. And certainly, I agree that part of the ultimate drawdown solution might be being able to spend your house in your latter years in a sort of equity drawdown type arrangement. If you have other assets that are worth something, I'm sure some technological solution to liquefy them would be good. So by voting for me, you get a bit of that idea as well. The other thing, though, that I would take exception to is that some sort of dashboard is going to make things better. A dashboard measures things. One of the things that really frustrated me during Tony Blair's government was once he'd set a target, he thought he'd solved it. A dashboard is just going to show the parlous state of most households' finances and offer no prospect of a solution. And so I do believe that what is required is innovation at the root cause, actually building a proposition from the right building blocks that are going to invest in proper innovation. I think one of the things that fund managers can sometimes do is aggrandize their own role. Our opportunity is really not to be fantastically innovative ourselves, but to spot innovation in the real economy and get behind it and invest in it and make the right returns for the end saver. So I want to get to the root of the matter. Of course, you'll have a nice digital dashboard to look at it. Of course, you'll be able to liquefy your assets. But fundamentally, what you need is a good drawdown fund that provides an income.
Thank you very much. Now, Nick, he's left a minute spare. This could be your opportunity if you want to take it.
And I would say that it's absolutely wonderful that we're in a hall like this, which is beautiful, and obviously we're going to get a lovely lunch, and we're in a very affluent town, and we're all wearing very nice suits. But the problem is that some people won't ever have the opportunity to be here. In fact, the majority of the population, over 50%, live hand to mouth and don't have any money to save. So the ability for them to even contemplate, not that they would understand what the word drawdown means, but to contemplate having a fund is unfortunately out of reach. And so what we actually need to do is to use tools like our dashboard to educate people from the moment that they are born to use all of the assets at their disposal, whether it be their future income, to get themselves up the ladder, to increase the prosperity that they have, and then, and only then, can they buy Euan's wonderful fund, which hopefully by 2050 will have solved all our problems and have been invented.
We're going to stop you there. Please use your apps to vote for the pitch you most agreed with. And again, there's this uncomfortable pause whilst we wait for the results to come up.
Oh my goodness. Oh, well, gracious and
Did I give you an unfair advantage? Thank you very much to all three of you for participating.
Local bias, I thought.
Congratulations, Euan. Nick, sorry.